Welcome, and thank you for joining us today for our webinar, Navigating Ginnie Mae Capital Requirements and HUD Updates. All participants will be placed on mute during the presentation, but during the Q&A session, feel free to unmute yourself to ask questions. You can also submit them through the question function in the webinar app. This webinar is being recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout this presentation. If you are looking to get CPE, you must answer all 4 polls to be eligible. If you qualify, the CPE certificates will be sent to you via email within the next few weeks. There will be a survey that appears on your screen at the end of this webinar. Your feedback is extremely important to us, and we want to provide you with as much value as possible through these webinars. If you would take a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richey Mae, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And now I'd like to turn it over to our presenters today. Rosie and Jerry, take it away.
Thanks, Alicia. Hello, everybody. Welcome to today's session. My name is Rosie Marlier. I am an assurance partner at Richey Mae on the mortgage banking side. I've been with Richey Mae since January of 2015. I'm highly involved in the financial statement audit side of everything, but I also assist in managing the compliance side of everything, which is how I ended up here today.
And my name is Jerry Pearson. I'm a compliance specialist in the mortgage banking side. I'm going on my 7th year. Started out on the audit team for about 2 years and then moved over to the compliance side.
All right. So to go through today's agenda, we are going to cover the revised Ginnie Mae financial requirements, starting with the why behind Ginnie Mae has gone down this route. I want to do a quick refresher on the Ginnie Mae insurance, net worth, and liquidity requirements. And then I'll jump into the new Ginnie Mae capital requirements that are effective December 31st, 2024. So it's coming up quickly. We'll go through some calculations and examples of these new requirements. Then I'll pass it off to Jerry. She's going to go over some compliance hot topics by looking at 2024 HUD mortgagee letters and the Ginnie Mae APMs that came out this year. So the Ginnie Mae financial requirements, when did they come about? Ginnie Mae issued multiple APMs related to this starting back in 2022. The main one that everybody is familiar with is APM 2209, which was the single family applicant and issuer financial eligibility requirements. This was the APM that rolled out new net worth and liquidity requirements effective September 30th, 2023. As well as a risk-based capital ratio requirement that was supposed to be effective December 31st, 2023. However, shortly after that, APM was issued. They issued 2211, and this offered an extension of that implementation date related to the capital requirements. So it's moved now to December 31st, 2024. I threw on an APM related to manufactured housing. For the purposes of today's session, we're going to focus more on single family, but there are updated eligibility requirements for multifamily, manufactured, and those types of programs as well. And then finally, exactly last week, 1 week ago today, they issued APM 2412, which is offering capital relief for those that are hedging their MSRs. So we'll take a deeper dive into that a little bit later in the presentation. So why did Ginnie Mae take this route? Their goal was to promote confidence in the safety, stability, and vitality of the MBS programs. Despite any type of market, whether it's up or down, they wanted to make sure that their issuers were in a good spot. They also wanted to align more closely with FHFA. They wanted to make sure that the regulatory burden was reduced and that there was more consistency and predictability between Fannie, Freddie, and Ginnie. And then finally, they wanted to upgrade their counterparty risk management program. The housing finance system is ever changing, and the scale of Ginnie Mae is vastly different than what it was before. So some of the ways that the scale of Ginnie Mae has changed. So prior to 2008, when the crisis happened, there was only 600 billion in UPB. As of September 24, that number has gone up to 2.64 trillion. I added all of the zeros so people can see the magnitude of that. That roughly equates to 340% increase in UPB over the last 16 years. Back in March of 2022, Ginnie Mae was noticing that their IMBs were responsible for about 80% of the outstanding single-family mortgage-backed security issuances, as well as responsible for originating about 90% of the single-family mortgage loans. So that origination is up from less than 50% prior to the 2008 crisis. So because of the IMBs having such a huge impact in Ginnie Mae's program, they wanted to bolster long-term viability of the IMBs during all economic cycles. Before we jump into the financial requirements, I wanted to draw some attention to the different remittance types, since they do play a pretty significant role in how these calculations work. This snip is actually from Fannie Mae's selling guide, so you'll see some Fannie Mae language in this table, but I do think it does illustrate some of the differences. So the first remittance type is going to be actual to actual, and what that means is that the actual principal and interest that's collected from the borrower is passed through directly to the investor, which is the opposite of a schedule to schedule remittance type. So regardless of what is collected from the borrower by the lender, they have to still pass through the scheduled interest and the scheduled principal to the investors. And then a hybrid of the two is going to be your scheduled to actual remittance type. This is where the scheduled interest is going to be passed through, but they only pass through the actual principal that was collected from the borrower. The significance of these is that schedule to schedule carries a little bit more of a risk to lenders in the sense that they are on the hook of advancing all of those funds through regardless of what they collect. People a lot of times associate actual to actual with Fannie Mae, schedule to schedule with Ginnie Mae, and schedule to actual with Freddie Mac. But in reality, there can be various different types of remittance types within each of these agencies. That's just sort of how people associate them typically. If you want a easy way to remember which one's interest and which one's principal, Seth Spray gave me a quick tip. If you just go down the alphabet, I for interest comes before P for principal. So the first word in these remittance types is going to represent the interest. The second is going to be the principal. So the first requirement that Ginnie Mae has is related to fidelity and E&O insurance. They have 4 different tiers based on the total servicing portfolio size. So that first tier is going to be $100 million or less. And then it goes from 100 million to 500 million. Third is 500 million to $1 billion. And then finally, everything over $1 billion. The minimum coverage that you need is 300,000. And then it tiers up from there. So second tier, they're going to add 15 basis points. Third is 12.5. And finally, 10 basis points for all those amounts over $1 billion. And then in that third column, you can see the maximum deductible requirements. Directly in Chapter 2, they give you an example of how to calculate that if you want to use this table as a resource. In Chapter 2 of the MBS guide, they also discuss fidelity and E&O caps if you think that that might be applicable to your company. Next, they have net worth requirements. So these are the new updated ones that were effective September 30th of 2023 from that APM 2209. They are requiring a base net worth of $2.5 million, and then they're going to add additional net worth based on your servicing portfolio makeup. So all your Ginnie Mae single family outstanding obligations are going to be 35 basis points. The definition of that is going to be all of your single family Ginnie Mae securities outstanding, plus your available commitment authority to issue your new single family pools, plus total single family pools funded. And then they're going to also add 25 basis points for both GSE or enterprise. I'm going to use those terms interchangeably. The outstanding servicing UPB of those loans, and then 25 basis points for non-agency outstanding servicing UPB. The reason I have this titled as existing issuers net worth is Chapter 3 of the MBS guide is going to be maintaining your eligibility, so they're already participating in Ginnie Mae's program, versus Chapter 2, which is going to be for the applicants. So this formula is still going to be the same for applicants, except obviously they're carving out the 35 basis points of Ginnie Mae since you wouldn't be participating in that yet. The next change is to issuer liquidity. So they have new liquid assets that are considered eligible for your liquidity calc. The assets are made up of cash and cash equivalents, any AAA rated government securities that are marked to market, GSE MBS marked to market, GSE obligations marked to market, and then they're also allowing both principal and interest and taxes and insurance advances, as well as foreclosure advances. These servicing types of advances are now allowed to be included in your liquidity calculation. So the new calculation for liquidity is going to be a base liquidity that's equal to the greater of $1 million or the sum of the following. They are going to, this is where those remittance schedules, you can actually see them coming into play. So 10 basis points of your Ginnie Mae servicing UPB is going to be required. And then for all loans on a scheduled type remittance, so both schedule to schedule and schedule to actual for GSEs, are going to be 7 basis points of the servicing UPB. And then because actual to actual carries a little bit less risk, they're only requiring 3.5 basis points of GSE servicing UPB for that type. They also are going to be adding 3.5 basis points for non-agency single family servicing UPB. They also have added an origination liquidity for their larger and medium-sized issuers. So for those issuers, if any UPB issued in any 4-quarter period exceeds $1 billion, they're now going to require you to calculate 50 basis points of your loans held for sale, as well as 50 basis points of your pull-through weighted UPB of your interest rate locks. So that's going to bring us to our first CPE question. Felicia, I'll let you take that one.
Thank you, Rosie. Our first CPE question, I'll read it for everyone. How confident is your company in understanding the revised net worth and liquidity requirements? So you're going to answer one of these. My company fully understands the changes from last year. The second answer, we know there are changes, not sure we're doing them correct. Third answer, we had no idea about the net worth and liquidity updates, so good thing we're on this webinar. And the fourth answer, the new rules do not apply currently to my company. So again, a reminder, there will be 3 more polls in addition to this one. In order to earn CPE, you need to answer all of these poll questions. So I'm going to keep it open for about 15 more seconds to make sure that we get as many people seeking CPE as possible. So again, just a few more seconds. Rosie, this is really going to be interesting. So I'm glad everyone is here today. Okay, going to go ahead and close this and share the results. Rosie, 43% answered to the first one. My company fully understands the changes from last year. 31% said, we know there are changes, not sure we're doing them correctly. 0, nobody answered, we had no idea about the net worth and updates, which is great. And 26% said, the new rules do not apply currently to my company. And with that, I will take it back to you, Rosie.
Okay, perfect, thanks. Okay, so now I want to jump into the new issuer capital requirements. Again, this is effective December 31st, 2024, so it's sneaking up on us. They have a couple different buckets where they talk about the different types of issuers. So any issuers that are subject to the Fed, FDIC, OCC, NCUA, or the FHFA, they have to meet all regulatory capital requirements in order to be considered well capitalized. Typically, non-depository mortgage companies are not going to fall into this category. Additionally, instrumentalities of a US state or territory, they are also not subject to institution-wide capital requirements, but any issuers that don't fall into those first two categories are required to maintain a leverage ratio of at least 6%. The significant change now to this is that they're implementing a risk-based capital requirement, or RBCR, in which they will be risk weighting the assets now. So the calculation of RBCR is your adjusted net worth less excess MSRs over that risk-weighted asset number. Excess MSRs are defined as any MSRs that are in excess of adjusted net worth. Not all assets are going to carry a risk weighting. So cash and cash equivalents, reverse mortgages held for investment, any Ginnie Mae loans eligible for repurchase that are on your balance sheet, prepaid expenses and leases, and then finally the items that are deducted from equity to come up with your adjusted net worth, or those unacceptable assets. None of those carry a risk weighting. They're going to be calculated at 0% in your table. However, government and conforming loans held for sale, they carry a 20% risk weighting. All other loans held for sale are 50%. And then the big boy, which has caused the most talks in the industry, some of the pushback, is this 250% that's related to your gross MSRs. And again, they are not to exceed your adjusted net worth. And then any other assets that are not in that table above are going to carry just a 100% risk weighting. So why is Ginnie Mae offering such a large risk weight on the MSRs? They said that they're trying to balance the importance of holding the MSRs and creating value there with limiting the actual risk to the MSR portfolio. They're limiting the risk by that 250% risk weight, but they're also making people directly deduct the excess MSRs from adjusted net worth. And they're offering 3 reasons for why they're requiring that direct deduction. So the first is going to be high volatility. MSRs are valued by using inputs such as prepayment speeds, discount rates, cost of service, among many other inputs. Any changes in interest rates can directly impact those inputs, like prepayment speeds. Borrowers are more likely to refinance when rates drop. That's going to impact the value of your MSR portfolio. And anytime you have those types of changes, it's creating high volatility for the issuers. The second is valuation risk. So due to those unobservable inputs that I mentioned before, MSRs are considered level 3 assets in the financial statements. Depositories are highly scrutinized for their level 3 assets by federal regulators, but IMBs don't have that kind of scrutiny. And so Ginnie Mae is considering them as a higher valuation risk as maybe some of those depositories. And then finally, leverage risk. So this is a big one. MSRs can help issuers obtain additional leverage. Therefore, in a rapidly declining market, margin calls and credit runs can be high risks, which threaten the issuer's solvency. I was looking at a Ginnie Mae FAQ, and they provided an example. So say a company has MSRs that are 3 times the value of the adjusted net worth. If the value of the MSR decreases 25% in 1 quarter, the impact to the net worth is a decrease in 75%. So if you put numbers to these, say a company has a net worth of 100,000 and their MSR is 3 times that at 300,000, if the MSR takes a 25% hit, that's going to drop the MSR $75,000, which is a P&L impact. So your issuer's net worth is going to go from 100,000 all the way down to 25,000, or a 75% drop. So MSRs are considered highly risky assets. So with that said, I wanted to jump into an example of this. So putting some numbers to how you can look at this risk-based capital requirement. So assuming a company has an adjusted net worth of 600, cash and cash equivalents of 100, government loans held for sale of 100, conforming loans held for sale of 1,500, other loans held for sale of 100, gross MSRs of 800, and other assets at 500. Those are the assets on their balance sheet. The first thing you're going to want to look at is your excess MSR. So the risk weight of the 250% is applied to the lesser of your total MSRs or your adjusted net worth. So because their MSRs are 800 and their adjusted net worth is 600, this company has excess MSRs of 200. So you're going to list out all of your tables or all of your assets on a table. You're going to put your risk weight, but instead of using that 800, you want to go ahead and use the 600 while calculating that and take the 250 across that. The formula is going to now be the adjusted net worth of 600 less excess MSRs of 200 over those risk-weighted assets from the table of 2,370 that you see right here. That comes out to a ratio of 16.9%. So pretty straightforward calculation, but that you can see the impact of having to use those MSRs and gross them up, how detrimental that can be to your actual ratio. So last week they came out with APM 2412. So Ginnie Mae is now offering relief to issuers that are successfully hedging their MSRs. They're going to use quarterly MBFRF data in order to calculate hedging efficacy, which is defined as the proportion of derivative gains and losses used to hedge MSRs relative to the change in the MSR values due to market and model changes. Once you determine the hedging efficacy, they offered a table that has MSR value adjustments. They're going to look at that on a quarterly basis. Ginnie Mae is then going to take the average of the MSR value adjustments over 12 quarters in order to get that percentage. For any issuers that have not hedged in the past 12 quarters, they're going to use an average of hedging performance that is available. However, you do have to meet minimum eligibility requirements. The first is that you have to have hedged at least 4 out of the 12 most recent quarters, and you must have hedged in at least one of the most recent 4 quarters. This is the hedging efficacy table. So at the top, you can see they have different ranges, those proportions of gains and losses related to MSR changes from the market and model. And they've assigned a different percentage that you can use to incorporate into your Ginnie Mae capital requirement calculation. In the APM, they offered 2 examples. The first example here is going to be all quarters before 2024. So you have your rolling 12 months. And in this example, they only hedged for 4 quarters. So looking at September 2022, you can see that there was a hedging efficacy of 135%. So using that table, the 135 is falling into that category between 121 and 140. Which is how they're coming up with an MSR value adjustment of 40%, negative 40%. And they keep doing that in all of the other months. And then they're going to take the average of those 4 periods in which they came up with negative 35%. In the second example, they are going to have quarters beyond 2024. In this example, they have 10 actual quarters of hedging. In September 2024, you can see that 125. Using that table again, it's falling in that 121 to 140 range. So that's how they came up with the MSR value adjustment of negative 40%. So taking the average over those 10 quarters after 2024, it actually changes the MSR value adjustment to negative 20%. So I want to look at the exact same example as we were looking at before. except in this instance, they had that hedging efficacy calculation in which they had negative 35%. So they're going to take an MSR adjustment using those gross MSRs of $800 times 1 minus 0.35, coming up with an MSR adjustment of $280. So now the total MSR is going to be valued at $520 rather than the $800. What that means is your adjusted net worth is $600 and the total MSR is $520. So there are no excess MSRs that need to be backed out of the RBCR calculation. So here's that table again. Everything else stays the same, except you change your gross MSRs to 520, and now the denominator of your calculation dropped from 2,370 to 2,170. The impact of that is you're going to calculate it using your adjusted net worth, which is still 600. You don't have to back out the 200 anymore since you don't have excess MSRs, and you have a lower denominator because of those risk-weighted assets being a lower amount with that MSR valuation. So the new ratio being calculated is 27.6%. So if you compare that to what we saw before at 16.9%, you can see how this APM 2412 is allowing excess relief from that. So I'm going to kick it back to Felicia for our second CPE question.
There we go. Okay, everyone, here's our second question. Does your company currently hedge MSRs? First answer, we do not currently have an MSR asset. Second, we do not hedge our MSR asset and do not intend to. Third, we do not hedge our MSR asset, but we are exploring options. And the last answer, we typically hedge our MSR asset. So again, we want to make sure that we get you that CPE credit. So I can see we're still missing some folks. If you can take the next 30 seconds here and get your answers in, we can make sure that we get that CPE certificate on its way to you. Just a few more people. There we go. Okay, I think everybody's in. I'm going to go ahead and close this and share the results, Rosie. 34% answered we do not currently have an MSR asset. 31% said we do not hedge our MSR asset and we do not intend to. Only 5% said we do not hedge our MSR asset but are exploring options, and 31% said we typically hedge our MSR asset.
What was D? How many are hedging?
How many are hedging? I'm sorry, I just closed that. Let me pull that back up. 31%. That's okay.
So
31%.
It's a pretty decent chunk. It's higher than I actually thought. We do have clients that definitely hedge their MSRs. It's not that infrequent, but there are certain factors that kind of come into play with this, and a lot of people out there kind of consider it an expensive option. So it should be interesting to see if there is a shift in how, from an operational standpoint, companies are kind of looking at this going forward based on this new APM and the relief that it brings for the Ginnie Mae capital requirements. That is all I have for the financial requirements. So I'm now going to pass it off to Jerry to cover some of those compliance hot topics.
Thanks, Rosie. So for the rest of the presentation, we wanted to talk about some compliance hot topics that we've heard about on different industry calls, webinars, and then also look at any compliance related HUD mortgagee letters and Ginnie Mae APMs from this past year. Rosie, if you can go to the next slide. So a couple things that have been common themes around HUD hot topics from compliance and quality assurance webinars have to do with monitoring of your net worth, your liquidity, your net operating losses, and making sure you're reporting them timely if you're deficient. We've seen lots of citations in the Mortgagee Review Board administrative actions that came out in March 2024 relating to these. So just wanted to make sure this was on your radar to keep these in the back of your mind and looking at them on a timely basis. So your net worth, your liquidity, if at any time you fall below the HUD requirements, you do have to report that within 30 business days. Your net operating loss, you need to calculate that quarterly and report that within 30 business days of the end of the fiscal quarter if you have a loss that is more than 20% of your net worth. The other thing that came up, I was on a call with HUD the other day and I asked them, I'm like, hey, we're doing this webinar. Is there anything you want me to bring up? And what they stated was, please make sure when you're doing your adjusted net worth calc that you understand what those unacceptable assets are that you have to back out from your adjusted net worth. You're going to find those from HUD in the Consolidated Audit Guide 2000.4, Chapter 7.5. And then for Ginnie Mae, you're going to find it in Chapter 6 of the Consolidated Audit Guide on Attachment A. And just keep in mind there are differences. So when you're using those unacceptable assets, make sure you're using the right set for your calculations. The other thing that we've had a lot of confusion on and had people question is making sure that you are understanding the definition of an affiliate when it's related to your quality control. So it's not just if you use a third-party originator. The definition from HUD is if you're using contractors, agents, vendors, subservicers, or those sponsored TPOs who participate in FHA programs on behalf of you. So keep in mind there are quality control requirements surrounding affiliates. Make sure your quality control plan has those required elements and you are monitoring those affiliates on a semi-annual basis. The last thing that came up a couple of times was make sure that you're watching those default and claim ratios, those compare ratios. HUD said they're doing that on a quarterly basis and they're fully expecting that you should be doing that as well. So that way, if there are issues, it's not going to come as any surprise when they're reaching out on that. So those were kind of the common themes that we saw on different industry calls. Next, we're going to look at a focus that seems to have came up from both HUD and Ginnie Mae this year, and it's regarding cybersecurity incident reporting. And I'm going to take a little break here. I'm fighting off a cold. I got to take a quick drink. So give me 1 second. Okay, Rosie, if you want to go to the next slide. So both HUD and Ginnie Mae this year came out with mortgagee letters and or APMs relating to reporting of cybersecurity. They both define it with the same language. So a cybersecurity incident is an event that actually or potentially jeopardizes without lawful authority the confidentiality, integrity, or availability of information or an information system, or constitutes a violation or imminent threat of violation of security policies, security procedures, or acceptable use policies, and has the potential to directly or indirectly impact the FHA-approved mortgagee / issuer / document custodian's ability to meet its obligations. So HUD came out with a letter in May stating that if you have a cybersecurity incident, you do need to report it within 12 hours of detection, and they have 2 different emails that they have you reporting it to. So you can see both of those there. If you go to the next slide, Ginnie Mae came up with 2 APMs this year. One relating to issuer requirements, one relating to document custodian requirements. Both of them have to be reported within 48 hours of detection and using that same email address for Ginnie Mae. So if you as an issuer have a cybersecurity incident or your document custodian does, you do need to be reporting those to Ginnie Mae. All right, next we're going to take a quick break and have one more CPE question. So Felicia, I will turn this over to you.
Sure, thank you, Jerry. Our poll question is now, do you have a cybersecurity program in place? Yes, no, or not sure? A lot of folks on this call might not be sure. That's quite okay. I love seeing a lot of the yeses come through. Again, we want to get you the CPE credit. Need a couple more people to get in there. Don't miss this. Going to keep it open for just a few more seconds. Jerry, do you want to guess how many people said yes before I finish this?
I'm going to hope 100%, but perfect world.
Close. We have 84% answering yes, 2% saying no, and 14% saying not sure. You know, a lot of times folks that will be on this call aren't necessarily inside the loop and understanding all the protections that their company may have, but hopefully you're getting a lot of training too. So I'm going to turn it over now back to you, Jerry.
Perfect. All right, so next we want to look at a couple of HUD mortgagee letters that came out in 2024 that are related to compliance. So we're not going to look at everything, just the ones that we felt were important from a compliance standpoint. The first one came out in March, having to do with changes in the branch office registration requirements. So HUD has now made it optional to register your branch offices in which you originate, underwrite, or service FHA insured mortgages. It's no longer a requirement that you do so, it's totally up to you. You do still need to make sure that any branch offices you have continue to meet HUD's requirements for office facilities, licensing requirements, operating requirements, and things like that. But you no longer have to register all your branches. So we've had a few people reach out, ask us what we've heard on this, what our thoughts are, and we're kind of in the same boat as you guys. We don't really have a lot more information than what HUD has provided with that mortgagee letter. The only thing that I've heard, one of my clients had a call with HUD to talk about this and was told, you know, if you're not registering your branches, you're going to lose access to any branch data in Neighborhood Watch. So if you're using that to monitor default and claims ratios or anything else, you're going to lose that data. So if you're not registering your branches, make sure you have a plan in place to capture that data that you're going to need to perform any analysis that you're doing. We did ask all of our clients when we started our compliance testing this fall what they were doing just to kind of get a pulse on it. And it's probably split about 50-50. About half of our clients are registering all their branches, the other half aren't. So we're not really seeing people leaning a certain way, but just wanted to kind of share that little bit of information with you. All right, the next slide, or the next mortgagee letter we wanted to talk about came out in May, and it was about updating your unique identifier number, your UEI number, which came out last year. So a couple of things to take away from this. You should have an active UEI number registered with sam.gov, and it should be listed on your LEAP portal. If you sign into your LEAP portal up in the upper right section, it's going to be in the box up there with an expiration date. Those numbers have to be renewed every 365 days. So it's not by a certain date, it's within 365 days from when you got the number. So please make sure you're looking at your LEAP portal because a lot of those are coming up for renewal now. And last thing that we want to see is that that number expires and we get to where you're doing your recertification and you might have issues because your number isn't active. The other thing we saw on this was if at any time that status becomes inactive, it's going to reflect in that LEAP system, and you could be subject to a referral to the Mortgagee Review Board. And we know none of us want that to happen. So please make sure you're monitoring that number. If it's expiring coming up, put some calendar reminders out there. Make sure you're giving it plenty of time. Don't wait till the day of, because we all know how the systems work sometimes. So make sure you're giving yourself enough time to renew that number. Okay. Next slide is going to be 2024-14, which came out in July, about fraud or misrepresentation involving sponsored third-party originators. Basically what it did was HUD came back and said, you guys are responsible for the action of your sponsored third-party originators. They've updated the Appendix 8 in the back of the HUD handbook and that defect taxonomy to include that any fraud or material misrepresentation involving a sponsored TPO is one of those that you should know or should have known about when they're looking and doing their reviews and determining severity of findings. So make sure you're monitoring your TPOs. We know that you should be doing QC reviews of loans that they're originating. So if you're finding instances of fraud or material misrepresentation, make sure those are being reported to HUD or you could get cited for that. All right, those were kind of the ones we felt were important on the HUD side of things. Now we'll take a look at the Ginnie Mae APMs that were issued during 2024. All right, so the first one was APM 24-04 that came out in March. Ginnie Mae Central Application for Issuer Insurance and Audited Financial Statement Submissions. So this is going to come in play with your submissions that you're going to have to do at the end of this fiscal year. But effective with issuer submissions on or after May 13th, 2024, you're now going to be required to use the new Ginnie Mae Central Application System, the GMC, when submitting proof of both your fidelity bond and errors and omissions insurance and your financial statements that will come from the audit. So you're no longer going to be submitting your insurance through the financial reports review agent. You're going to go through that new central application system. Another change they have is that you will be submitting a full and valid copy of the fidelity bond and E&O insurance policies at the time the policies are renewed or obtained. So it's no longer required with your financial statement submission. You need to upload them when they're renewed or obtained. They do have to be submitted within 30 days of obtaining new or renewing coverage. And then effective with your issuer submissions on or after May 13th, you're going to be required to use that same system to submit your audited financial statements that are due within 90 days after the end of your fiscal year end. So that'll be a new change coming up this year. Your financials have to be certified by your chief executive officer, your chief financial officer, or an equivalent person. And any extension requests must now be submitted through that same central application system and will no longer be accepted by letter. So just wanted to make sure that's on your radar as we start approaching those dates when you're going to have to be submitting those items. All right, and the last one we wanted to talk about is going to be taking effect December 1st, so just in a couple weeks. Involves single family payment default status loan level data elements. So starting December 1st, you will need to be reporting information as to why a loan may be in default, any mitigation actions that may have been taken, and timing of those actions. So that's going to take place December 1st for the November reporting period. So you're going to want to make sure you have that data available when you're doing your Ginnie Mae reporting. To find out more information on that, check out Chapter 17 of the Ginnie Mae MBS Guide in that reporting and feedback system reporting process, and you can find all those details out there. All right, so we're getting ready to conclude our presentation today. If you're looking for more information on any of the topics we covered, there's going to be resources in the back of the document you're receiving. You can click on the links to the Ginnie Mae MBS Guide, all the Ginnie Mae APMs, the HUD Mortgagee letters, the Fannie Mae Selling Guide. All of that information is going to be there for you. We're going to have one more CPE question, and then we'll open it up for a question and answer period. So Felicia, I'll turn it over to you.
Thank you, Jerry. Again, this is our last CPE question. Are you ready to report on the new default status elements that will be required starting 12/1/24? Yes or no? And again, we want to make sure this is our last question to get you that CPE credit. It's a little bit easier to answer than some of the other ones were, I think. At least easier to talk about, huh? Yes or no? You know, that's the purpose of this webinar, is to get you ready as well. So we want to make sure if you need additional information that we get that for you. Okay, I think I just want to wait just a few more seconds. I know there's some people that were looking for CPE credit, and I want to make sure that you get in. And with that, Jerry, I'm going to go ahead and close it and share those results. We had 78% say yes and 22% say no. So maybe that's something we can talk about. Okay, I think we're going to move on to question and answer. And Rosie, if you want to go ahead and come back, we do have a bunch of questions that came in. The first one is, if the goal was to align FHFA and Ginnie Mae, what are some of the areas they are not aligned in? We have a couple questions in this vein, if you want to kick us off with that one.
Sure. So they actually are pretty heavily aligned. We can send a link to people if they want to see sort of like a side-by-side comparison. They have that sheet available, but there are some small differences in the unacceptable assets that get backed out of net worth, as well as some differences in the eligible assets used for liquidity. The FHFA, I believe, is allowing a portion of your servicing advance line of credit, whereas Ginnie Mae, if you remember from the calculation, they're actually allowing those advances for P&I, T&I, and foreclosure advances for the liquidity calc. So a little bit of a difference there. Additionally, let's see, there's for that origination liquidity piece, FHFA is factoring in what they're calling a liquidity buffer. I think it varies from 2 to 5 basis points depending on whether it's GSE or Ginnie Mae servicing. And let's see, for the capital ratio or the leverage ratio, depending if it's FHFA or Ginnie Mae, they both are requiring 6% for that ratio, but FHFA is not requiring that risk-based weighting system like Ginnie Mae is.
Okay, here's a related question that I think I'll throw in at this part. The Ginnie Mae MBS guide and the HUD chapters seem to clash. How do we know which calculations and unacceptable assets to utilize?
Yeah, I can take this one too.
Yes, go ahead.
So yes, they do not align currently. The HUD chapter 6, which is Ginnie Mae, and 7, which is FHA, still have the old appendices with the old HUD calcs. In Ginnie Mae's APMs, they did add blurbs at the bottom saying that if at any time the two seem to conflict, that the APM trumps the HUD chapters. I know for last year in our financial statements for the supplementary schedules, we sort of showed a side-by-side to be careful whether, we didn't want to not show if HUD was looking for the old calcs and Ginnie was looking for the new ones. You definitely want to make sure that you're using the new ones, since that's what Ginnie Mae is going to mostly care about. The unacceptable assets do differ between the two. Chapter 6 and 7 have different unacceptable assets at the end of the chapters, but it's really important to also pay attention to the MBS guide specifically. They really call out like deferred tax assets, net of liabilities, and some nuances there. So you want to make sure that you're sort of checking all 3 places and making sure you're covered so that all of your regulatory requirements are being met regardless of them not seeming to align perfectly there.
Okay, and again, just a reminder to all, if you would like to ask a question, you can unmute yourself or put it to us through the question app. Got a couple more. Let me just jump down to this one. What are some factors to consider when it comes to hedging your MSRs?
There's a lot of factors. I just recently read like an MCT white paper on this. I think some things that you want to consider is the size of your portfolio. If you seem to have a lot of servicing in relation to your originations, you might be a good candidate to look into hedging your MSRs. There's different types of instruments that you can use in order to hedge your MSRs. So I've seen forwards being used. The TBAs might not be a perfect option, but that is used a lot. Sometimes there's like interest rate swaps that you can kind of do, or options. So there's a lot of types of different instruments that you can use to hedge your MSRs. You definitely want to make sure that you're paying attention to the costs related to those instruments, and then also the team that you need in order to effectively manage your hedge is going to be important. If you think about hedging for your interest rate locks, you have an entire secondary team. Hedging your MSRs, you'd probably want to make sure that you have the capacity to run it similarly to that. And then another thing to consider with hedging your MSRs, if you don't have great ways of recapturing, so recapture, making sure that you can get some of those borrowers back if they're going to end up refining. Companies that maybe are more heavily retail versus direct to consumer might want to consider looking into hedging your MSRs.
Okay, our next question, let me just get back to that. If we have excess servicing, should we be netting them with our MSR asset for the Ginnie Mae capital calculation?
My understanding is that you should not be netting them for excess servicing. The calculation specifically calls out gross MSRs. When they opened this up to comments, back in, I guess that'd be like 2021 or 2022, they got a lot of pushback on this excess MSR. They wanted some relief for those of them that were selling them. And Ginnie Mae did actually find some validity to those concerns. And to curb that, they dropped it from what was originally at 10% down to 6%. So that's kind of the only relief they have out there. But I do believe they are still exploring other options related to excess servicing.
Okay, we've got one more that just came in, and it's a two-parter, so I'll just do the first part. Did you say deferred tax assets net of liabilities, not gross?
That is how it's worded. That's our understanding. And I believe if you look at the side-by-side comparison sheet, they're specifically saying deferred tax assets, but they are letting you net your deferred tax liabilities with that.
Okay, great. And then the last part of that, and did the audited Ginnie Mae capital requirement from our 2024 financial statements exclude the risk-based capital requirements because they weren't applicable until later?
I'm not sure I understand. Can you repeat that question, please?
Did the audited Ginnie Mae capital requirement from our 2024 financial statements exclude the risk-based capital requirements because they weren't applicable until later?
Yes. So yeah, because it's not effective until December 31st, 2024, you would have been using the original Ginnie Mae capital requirements. This year is the first year that it's going to impact those supplementary schedules with that risk-based capital requirement.
Awesome. So that's the end of my questions, unless someone has one last question they'd like our experts to answer. I don't see any coming in right now. Just want to make sure someone's not trying to unmute themselves. Okay, don't think so. Yes, with that, I'd just like everyone, thank you so much for attending today. As a reminder, you will be receiving this recording and the slide deck within a few business days, as well as your CPE certificate for those of you who qualified. Thank you, Jerry. Thank you, Rosie. It was a pleasure to be here with you today, and we will see you at our next webinar. Thank you all.
Thanks, everybody.
Thank you.